A change in the current administration likely means a change in housing policies.
The most important thing from my perspective would be that we don't get a red wave or a blue wave. Whoever wins is likely going to have a slower economy, if not an outright recession.
One thing that's misinterpreted when it comes to presidency and a lot of things is that they control where house prices go. They don't directly control house prices, but...
So both candidates have expressed an interest in that, but without really any details to the plan.
This is The Educated Homebuyer with Jeb Smith and Josh Lewis.
A change in the current administration likely means a change in housing policies. And in today's episode, we're going to dive into what it could look like if Kamala comes in as president, if we get Trump as president. We're going to dive into some details here to help you guys become educated homebuyers. So Josh, big topic out there, a couple of weeks away, and there's beliefs on both sides of how this is going to impact housing. Let's dive it, or I guess break it down in a way that our listeners can understand.
Let me start with a belief that I have. So we get into election season. Politics has never been more divided in the U.S. So, but all along, people are like, this is my candidate, this is my party, and we have to get them in the office of get the presidency because it's essential, it's important, it's going to set. But when we look back, presidents get way too much credit when things go right. Mm-hmm. And they get way too much blame when things go wrong. Probably the best example that I can give here in recent memory, if you want to put your political hat aside and step back, is look at the inflation debate. We looked during Trump's presidency, and we're going to talk about this because it's some of what's being thrown at potential Trump 2.0 here. Inflation was just above or below 2% his entire time in office. So Biden, as we all know, we hit 8 or 9% at one point, depending on your favorite measure. So Biden sucks, right? The Democrats are terrible and they shot up inflation. So much of that was already in play because of COVID that was going to impact whoever was in that office. Now, we can certainly go to policy decisions that made it better or worse, but we were going to have much higher inflation, regardless of who was in office because of what happened through COVID. So all of the things that we're going to talk about and look at today, remember, this isn't partisan, is looking at the things that will impact the direction of housing, interest rates, affordability, all of the things that you care about. And when you're making a decision, if you're wanting to be a homeowner, wanting to become a homeowner, if you are a homeowner, and those are important voting decisions for you, we're just going to point out the things that each candidate thinks and believes, what we believe we know about them, because that varies from what they will actually be able to do if and when they get into office. And then also just sort of the impacts of the down ballot voting in terms of if Trump wins, but the Democrats control the House and the Senate, it really doesn't matter what Trump wants to do. So really, it's that holistic look, and we're going to take a look at it and go through what we know today in terms of what each of the candidates have said they would like to do if they're elected.
And also what they can control, right? I mean, we get comments on videos and on my other channel, like somebody's like, well, Trump's just going to put his guy in office and they're going to lower rates. That's not how it works, guys. There's more to it than just a person going in and changing policy. So we're going to dive into that. But if I'm being transparent here, you'd be really hard pressed to find someone that dislikes or just follows politics less than I do. I do not care about politics in any form or fashion. Now, I have my beliefs and I have things that I want to happen in taxes in different ways and things that impact, me and my family and that sort of thing. But at the end of the day, this is all a crapshoot, right? One person is not going to likely be able to do everything they want to do unless you get a sweep in either direction. And is that likely to happen? I guess, Josh, let's start there, right? So let's kind of start from the backside, right? So how do you avoid craziness in anything with regard to trying to get it passed, right? We talk about bipartisanship. We talk about having some sort of divide. A really good example before you dive in, Josh, California, super majority with one political party. Because of that, a lot of craziness happens in the state of California with things that get passed that ultimately probably shouldn't happen in so many ways because you have one party controlling everything. And for that, you have people leaving the state. You have people constantly using California as kind of like, poking the bear because a lot of irrational things happen because of one party, either way, getting full control. So how do we prevent that?
100%. And let's look at a couple of examples. So depending on which political hat you wear, you're going to like or dislike one half of what I'm about to say. So the two biggest examples that come to mind for me, when Obama first came into office, he had a blue wave. So he had the House, he had Congress, and they were able to ram through Obamacare. And Nancy Pelosi famously said, we have to pass this legislation so we can find out what's in it. And you are a special kind of partisan if 15 years later you're stoked about Obamacare. I saw the numbers the other day. In 2004, the average household spent $6,000 a year on medical insurance, and now it's $26,000. It's 400% increase in 20 years.
I am part of that camp.
100%.
Yes.
And most everyone, that's pain that everyone can feel. So we pass legislation where we can pat ourselves on the back and say, hey, we did it. What'd you do? You didn't do anything. It hasn't improved anything. It's worsened things for medical providers, so they get reimbursed less, but it hasn't made things better for us. We have done nothing. The flip side. So if you're a Democrat and you're mad at what I just said, let's go to the flip side. Trump in 2016, he has the House, he has Senate, he has a tax plan. Boom, the tax plan goes through. Many of the doom and gloom things that were said to happen because of that did not happen. It wasn't massively inflationary. It didn't lead to massive federal budget deficits. Those budget deficits then are actually cute, Jeb, relative to what we've come out the other side of COVID with. It's not funny, so I'm not laughing about it, but when you look at the charts, it's kind of amazing. So that is the type of legislation that can only get through when you have one party control of the full deal. And again, going back 16 years to 2008 when Obama comes in, 8 years to 2016 was sort of the start of this super partisanship where all of our elected officials in Washington are very proud of never cooperating with the other side. And notice I didn't say Democrats aren't happy with not cooperating with Republicans. Republicans aren't. All of them are not happy with cooperating. And the way we get good legislation is that we elect officials that represent our interests, and they go there and they come up with a plan that works for everyone. But instead, we've been getting years of executive orders. When we get these blue or red waves, then there's a piece of legislation pushed through that one side is happy with. So from that perspective, before we get into the actual specifics of housing, you guys are probably saying, hey, stop talking about medical insurance, stop talking about taxes, talk about this election and what is going to impact. The most important thing from my perspective would be that we don't get a red wave or a blue wave, and we have a divided government to the degree that they can cooperate and come and work on some of the things, whether it's deficits that have led to higher interest rates or have strongly contributed to higher interest rates and lower affordability, or any of the other types of legislation that should be a priority for whoever wins the election in 10 days to make things better for all Americans.
All right, so let's start there. Let's start with mortgage rates. Let's start with the Fed. What does the president control the Fed? First off, or I guess is the Fed? What's the right word? Are they swayed by who's in political office, right? Or should they be? And what can the Fed do with or without who gets in? I mean, there's clearly going to be a change, but does that change mean ultimately higher, lower Fed funds rate? And how does that translate to mortgage rates?
So they are political appointees, but it's supposed to be non-political. So once they're appointed and approved and get in, they're independent. They can vote their conscience. And there is a large group of Fed governors from around the country. So the Fed chairman has power. They lead those meetings. They lead that discussion at every Fed meeting. We get 8 of them a year, and they have the loudest voice in the room. But they're far from the only voice. And the reason for that is we have regional Fed governors that are seeing, something very different can be happening in Seattle than is happening in Florida or Georgia. So it is important that we have all of those voices because this is a huge economy. Like, we are one country, but if you look at it, like, Germany can be concerned about one thing, Spain's concerned about something different, but those are two different federal governments. In the US, we have to take all of that into account. So when we hear Trump say that he thinks the president should have a spot on the Federal Reserve Board, that's crazy.
We don't need any more influence.
We don't need politics. Politics has infiltrated everything. We need them to be as neutral as possible. These people are appointed by a president, but to signify that it is less political than other government positions. Trump appointed him, and he stayed through the Biden presidency. And, Trump liked him less than Biden did.
Yeah, and I think it's important to note that the members of the Fed, the voting members of the Fed, change. It's not always the same members is it every year that it changes? Is it yearly or is it every 2 years?
There are changes every year, but I think they go 2 years voting.
Yeah, so the voting changes within the Fed members themselves. So you could have people that are pro lower rates, then on the opposite side, you have people that are more bearish and want higher rates. So you've got both sides of it, and depending on who gets in, can determine what happens in actual Fed meetings. Now, with that said, Josh, we how does all of that translate to mortgage rates? I guess we've talked about this, but let's take presidency out of it a minute and just talk about what typically impacts rates. Let's make it quick, and then talk about what policies they're talking about that could impact rates.
So let's look at just last month in September. The Fed cut 50 basis points. Mortgage rates are up 0.75% at least. So let's take out of the equation. Mortgage rates are not directly impacted by the Fed. The Fed is trying to promote two goals: price stability and full employment. So the last 4 years, we haven't had price stability. Been too high. The rate of change year over year is too high, has been coming down, and we want that to normalize. The funny part is that 80% of the excess inflation above their 2% target right now is housing related. So interesting that we're a housing show here. If you are wanting to buy, you are well aware that housing is up, whether it's rent or owning a home, very, very high and uncomfortable for most people. And we're going to talk a little bit about the policies here. But in terms of the Fed can't say, hey, it would be much better for the president if people could afford homes, so we're going to drop mortgage rates to 2%. They don't directly impact them. Those mortgages get sold in the secondary market in the form of bonds. Those bonds have to compete against other types of bonds of similar duration. And anyone investing in those, whether it's treasury bonds or mortgage-backed securities, is saying, cool, I'm investing money. I want a real return over time, which means inflation, whatever that is, plus a real return on top of that. So I'm making a profit on my money. And the longer it gets locked up, 5 years, 7 years, 10 years, 30 years, the bigger return they want, because there's more uncertainty. We can be pretty certain what's going to happen in the next 90 days, far less certain what's going to happen in the next 9 years. So what the Fed what the president can control in relation to the Fed is making sure that the economy is strong, but not too strong. And also that we don't have excess inflation or runaway inflation. And we know smart people, Jeb, that think the correct number that the Fed should be targeting is 0 or 0.1, 0.2, just tiny amounts of inflation. At 2%, you still have prices doubling, every 25, 30 years. And that's pretty excessive. It changes a lifetime. When you start working and at 30, you're like, I need to put this in my 401k. You're not thinking that at 60, even with 2% inflation, it's half as much as what it is today. So big picture, the Fed is going to control what they can, which is primarily the Fed funds rate, to impact the economy to the extent that we're limiting inflation and hopefully keeping growth at a rate where most people that want to work can work and earn good wages.
Yeah, and I think it's important to note too, like a lot of people say, well, the Fed did this or did that during the pandemic. And understand, in 2020, Trump was the president at that time. That's when, the Fed did emergency cuts. That's when the government was stimulating the economy with a lot of money. And that continued into 2021 at a change of presidency. And the cuts continued and more money being spent. And yeah, inflation went up during that time, but it started happening. You don't see immediate changes in inflation as soon as things happen. It takes time to roll through. So both of the presidents in the last 4.5 years have had an impact on inflation. It's not one party over another. Now, we can say one contributed more than the other or vice versa. Your call, right? I mean, we don't know what we don't know. But what we do know is that inflation has come down. What we do know is that we have a slower economy. And what is likely to happen, regardless of who gets in, is lower mortgage rates to some degree. Now, let's talk about, I guess, that in a little bit more detail, Josh. What does the president, right? We talked about the Fed wanting price stability, maximum employment. Does the president care about lower rates? Like, what are they looking for in policy here that may or may not impact where rates go?
It's an interesting question. Just in terms of big picture, just think about like largely politicians of all stripes want their constituents happy, because if everyone's happy, then they're likely to get reelected. They get to keep their position. So what are the types of things for home buyers like yourself listening to the show that make you happy? Affordable housing. So wages increasing, interest rates low as possible, which the crazy thing we saw during COVID, really low interest rates is inflationary for housing. So it helps in the short run for the people that get in on the front window. But on the back end, when prices have gone up and interest rates have gone up, then it's problematic. So really, we need to improve affordability. So affordability, the three levers: home prices, because of the limited supply, and we're going to talk about each candidate's plans for supply. Because of limited supply, unlikely to move down in an appreciable way. We're not getting a crash. Could they come down? They could, but we're not getting a crash. Wages. If we're talking about, we believe that we're going to be moving into at least a slower economy, if not a recession. Wages will be relatively flat, but over time they grow slightly above the pace of inflation. So if we hit our inflation target of 2, you get 2.5%, 3.5% wage growth, then it makes things more affordable over time. The most important lever is interest rates. And again, going back to the decision of the Fed, who's in the office of president, who holds the House and the Senate, it is largely going to be dictated by the strength of the economy. If the economy is too strong, there's too many dollars out there, then you get inflation and rates have to go up to put a brake on that. It is most likely going into 2025 that no matter who wins the election in 10 days, that we're going to
10
see
days. Jeez.
And by the time this plays, Jeb, it's going to be 7 days. So whoever wins is likely going to have a slower economy, if not an outright recession. That should lead to lower rates. The Fed has told us their plan over the next 14 months, as of today, which it can change. They change it every meeting, every quarter, definitely when they put out their projections. But as of the last meeting and as of every Fed speaker we've seen in the 6 weeks, 5 weeks since then, their plan is another 150 basis points of cuts. They wouldn't be cutting if they thought the economy was accelerating. They think they've put the brakes on, and so now they're just taking their foot off the brake. They're not hitting the gas. They're not trying to reaccelerate the economy. They're just trying to say, we don't want to keep our foot on the brake and stall things out.
And I think one thing that's misinterpreted when it comes to presidency and a lot of things is that they control where house prices go. They don't, guys. Like, doesn't matter who gets in there. They don't directly control house prices, but some of their policy things that they do can have an impact on prices. And I think that's where we should go with the conversation here. It's not, hey, I want housing to be more affordable, so let's just make it affordable. No, it comes with passing things, that have an impact on those things. And one thing, Josh, that is, I guess, contrary to what people believe it, and that's home buyer tax credits, right? So let's talk about credits in the sense that there's a belief like, hey, housing is unaffordable for me. I don't have money for down payment. I don't have these things. But if someone were to give me the down payment, I could buy a house and then I would be able to take advantage of this whole thing. Does that actually make housing more affordable, or in turn, does it have an impact that makes prices potentially go up?
Here's a number. So
we've seen
down
this.
payment, that $25,000, Jeb, that's just the hurdle to get in. It doesn't increase affordability at all. It creates more able demand. We've talked about this. We have plenty of willing demand. Lots of people who don't own a home today would be willing to buy a home. They have to be able to make the monthly payment. They have to be able to come up with the down. So that $25,000 in most parts of the country covers that hurdle.
Well, let's talk about where's 25,000 coming from. Let's back up here because we just jumped in and said 25,000. So what are we talking about?
Kamala has a proposal, which there's lots of proposals, and both candidates have proposed lots of spending. And when the rubber hits the road, very little of it will be able to come through. But the details of her proposal at this point in time, she would have to get elected. She would have to formalize this. She'd have to introduce legislation to make it happen. But would be a $25,000 tax credit for first generation home buyers. So if you're out there estranged from your parents, don't have any relationship with them, but they live in a tiny, very modest home that they own in rural Alabama, you wouldn't get the $25,000. So we're picking winners and losers based off of
Winners.
where your parents, what they accomplished and what they did. By all means, we all know the silver spoon, the trust fund kids who have a leg up, but I also have lots of clients that like, I haven't talked to my parents in 15 years. What does their financial situation have to do with me?
Well, I think it's important to kind of take a step back and explain more about what first generation in this proposed tax credit means. It means basically if anyone in your family has owned a piece of real estate, yes, and it could. I think my understanding was it boiled down a little bit lower than that, like brothers, sisters, that sort of thing. Maybe it didn't, but anyway. So if your parents have ever owned a home, a piece of real estate, then in turn you don't qualify. Is that correct?
If they were to mirror the way it was with Cal HFA, with the Dream for All, it was, do either of your parents currently own a home?
Got it.
Or at the time of their death, did they own? So hopefully it would be just that simple. To me, it's problematic. If someone doesn't own a home and we're already putting income limits on it, like if we're saying, and Kamala's plan is 120% of the area median in most areas, 180% of the area median income in high cost areas like Southern California, Orange County, LA County, Bay Area, that type of stuff. So if you're a trust fund kid, you're going to have more, and you're not going to qualify for this. So there are ways to income base it. I mean, like, I agree. If you're a first generation home buyer, but you make $500,000 a year, you probably don't need government assistance to buy a home. You should be able to save some money. But if you're not a first time home buyer and you make $80,000 a year and you just need a little bump to get in, that, and again, as I'm saying this, it sounds like Josh is in favor of this. What the best example we have is going back to 2010. During the Obama administration, they said, hey, housing is really suffering. Prices went way down. No one's buying. The sellers that do own their homes can't get out of their homes because no one wants to buy. And they gave, I believe it was $7,500 or an $8,000 credit at that time. And what the impact of that was that it pulled a bunch of demand forward. So 2010 ended up being a pretty good year in housing. And the following year, it dipped again. So between those 2 years, no impact. So there's a couple things here. When we talk about increasing demand, when we have limited supply, it's not going to help in terms of prices or affordability. And going back to what does it do? So it doesn't help you make the monthly payment, but it helps you cover that initial hurdle of getting in. So now we have the problem of you have to be a first generation buyer. You have to make only a certain amount of money. But let's say you meet that criteria. And if you're in Detroit, $25,000 is awesome help for buying a home. If you're in Los Angeles, $25,000 is probably not going to get it done. So it's helpful still, but is that fair? Like, you just get to questions of equity, even for the people receiving the assistance. Mm-hmm. So from that end, Trump has zero plans of incentivizing in that way. Mm-hmm. Both candidates have expressed support for building on federal lands. So I don't know what those federal lands look like. When we drive out to Las Vegas, as you're going through the desert, most of that is federal land. Most people don't want to live out in the middle of the desert. So I don't know how much federal land that we have in the U.S. that's super desirable, where people would want homes to be built on. Both candidates have expressed an interest in deregulating the process of building homes. We've gone through this in the show. In California, it's pretty much $100,000 before you put a shovel in the ground. Yep. Just to break ground. That's insanity. We can deregulate that. We can decrease the taxes, the costs, the permitting, and the timeline to make that happen if we have land to build on. And builders are willing to build smaller, not McMansions, but 1,200, 1,500 square foot, 3-bedroom, single family homes that someone could afford. So both candidates have expressed an interest in that, but without really any details to the plans.
Yeah, and there was a stat, I've quoted this before, but I forget where I read it and exactly what the time frame was, but it was like the city of Dallas, Texas, built more homes than the entire state of California. In I think it was like a year or whatever the time frame. So a city built more homes than the entire state of California because regulation was less, because the cost to break ground was less. So those things matter. That's what has an impact on affordability. That's what you need more houses, right? So going back to prior elections and just the most recent one prior to this is when Biden was running, he also had a proposed tax credit. Understand, it didn't get passed. Why? It never happened. Why didn't it happen? Because it just, I don't even know that it ever came to light, Josh, to be completely honest. When he was running for office, it was something that was talked about. Maybe it was bipartisanship. Maybe so, it just never came to pass in general, just because of where housing was. But it's important to note, just because somebody talks about this doesn't mean it's actually going to come to light.
Campaign promises are exactly that. These people are trying to get your vote. When they get into the office, then they go, okay, how do I make the majority, as many people happy with as little legislation as possible? Because they only have so much political capital to pass anything. So you're going to say, how do we benefit the most with expending as little of that political capital, and what could get through? If you were a politician and you won the office of presidency and you had a plan that was going to benefit everyone and we had universal support for, boom, it just gets passed. Most of these things, there's a cost to everything, and it's hard to get them through. Jeb, one of the differences that I think most buyers don't understand or know until they get into the process, and you have a buyer that I'm doing the financing for right now that just found this out the hard way. Fannie and Freddie historically have priced all their loan level price adjustments. If you put less down, you pay more. You have a lower credit score, you pay more. And that is still the case. So there was a big hullabaloo a year and a half ago that, now I pay more because I have good credit. I put more money down, I got good credit. You don't pay more than someone with a lower down or worse credit, but the gap is way less. So you pay more than what you did before. So the pricing is a little bit worse for those with bigger down payments and better credit, so that it can be better for those that have bad credit
nice.
or low down. One of the biggest things, this is one for us here in California, Southern California specifically, where we have high balance loans. One of the things they squeezed in there, if you're putting less than 25% down on a high balance purchase. We've always had this. When they came out with high balance loans after the great financial crisis, they said, if you're going to do a cash out refinance with a high balance loan, you're going to pay 1 point extra. We don't really want to incentivize. The whole reason for high balance loans is we didn't have a fluid market for jumbo loans. So they wanted to be able to get as many people to be able to have access to financing as possible. But they said, well, we're not really trying to incentivize or facilitate cash out refinances on high balance loans. So the high balance loan has stuck around. 15 years later, we still have that. About a year and a half ago, they said, you rich people that are buying $1 million homes, you need to pay an additional point unless you are putting 25% down. And the reality is, this, Jeb, most of our first-time buyers here in Orange County, LA County, are $700,000, $800,000, $900,000 purchases. Most of those people don't have 20, 25% down payments. It's 5, 10, 15. And that 1 point hit, a 3/4 point hit, depending on how much you put down in the current market, we already have a little bit of a hit for high balance. We have a little bit of a hit for low down. Now we have the high balance purchase hit on top of that. You see a difference of a full 0.5% for those people versus if they were buying a standard balance and doing the same down payment. Now, is that fair? Again, they're buying equivalently to the cost, at the same percentile of level of home as that person buying in Detroit that's paying $125,000 for their house. They're not a rich person. They're just a person that lives in Los Angeles and wants to buy a house. So from that perspective, Trump, again, plans, not anything concrete, but said they would roll back the changes to the loan level price adjustments and go to the way it has always been historically, where it is completely risk-based and not equity-based.
Well, while we're talking about Trump, let's talk about tax credits. So when one of the things you mentioned earlier is in his original presidency, they were able to pass the SALT taxes, right? The tax credits through at that time, which changed basically how you file your taxes, what you get back, different deductions, that sort of thing. And it had an impact on housing, especially in higher priced areas because of what you could write off. And being here in California, because of where mortgages are and where prices are, you basically get to the point where you can't write off your property taxes to some degree. And one of the things that's been proposed or been mentioned is that if and when he gets in, that will likely be extended. And if he gets the opportunity to have both the House and the Senate, that it will essentially be permanent to some degree. On the flip side, there's if Kamala gets in, it's this idea that they're probably going to expire, and if they expire, then things change, go kind of back to the way that they were, and deductions change. So, Josh, how does that impact housing, or does it even impact housing?
So, Trump his tax plan that he passed in 2017, very early in his administration, what they did is they lowered tax rates across the board. So that in general is going to decrease tax receipts for the U.S. government. Anytime we're going to pass legislation, you have to try to make it as revenue neutral as possible. So to increase revenue, they capped state and local tax deductions. So primarily for most people, you have two things that fall into that category. Your property taxes if you're a homeowner, and your state taxes. So if you're in Texas, you're going, what in the hell are state taxes? If you're here in California and you make a good chunk of money, it can be 10, 12, 13, what do we like, 14% on the high end now, almost 15% of your income. So let's say you're one of those rich people in Los Angeles County, husband and wife both make $100,000 a year. So you got $200,000 of income, and you were fortunate enough to buy a $900,000 starter home. Well, that $900,000 home, in general, our taxes in California, 1.25%. So what are we talking about? A little over $10,000 or $11,000 for property taxes. And if you're at, say, 10% on your federal taxes, you got state taxes, you got about $20,000 of state taxes. Now it would be way less than that. You have some deductions, other things. Say it's $10,000. You easily have $10,000 of each of those. But under the new Trump tax plan that went into effect in 2017, you are capped at $10,000. So basically, every Democrat in the United States, every Democrat politician in the United States was against this. Most Republican politicians in high-cost states with high-cost housing and high property or high state income taxes also are against this. So there is a large percentage of politicians, not just the Democrats, that are against this. So given the opportunity, that state and local tax limitation of 10,000 will probably change. But since Trump put it in place, if he wins, unlikely to go away. And for people, especially in high cost areas, high state income tax states, they don't really realize how much they lost in terms of some of the benefits of homeownership from a tax perspective.
Yeah. And so the idea is that, I mean, again, it gets extended. Status quo, right? It looks just like it does now. In the case that it doesn't get extended, he gets in, doesn't extend it, she doesn't extend it, then there could be some additional benefits to home ownership, writing off property taxes, just some different things that could impact the bottom line and make home ownership a greater wealth builder, and kind of add to that bottom line. So, Josh, a lot of this is hypothetical in what we're talking about, right? A lot we at this point, we don't know who's going to be in. It's pretty much an even, 50-50, depending on what you're looking at online. So it could go either direction. So I guess paying attention to this, what should you be paying attention to? How should you make decisions? I mean, should your decisions be based around housing? The reality is probably not, right? You need to look at the bigger picture.
As you and I were talking about this, that was my exact thought. Like this is our industry. This is our business. So it is really, really important to us. It's not just my household, but it's also my household income. My wife's in the mortgage industry also. But even with that, I'm sitting here going, are these the things that I'm going to vote on? Like if one of them had a horrific, terrible plan, I could probably say I'm against that. I am not going to vote for them. But these are important details to be aware of if you are a homeowner, home buyer. But I don't think these are necessarily the decisions that you're going to cast your vote based off of.
Well, and with that, I mean, we have some notes here, like, again, you need approval. None of this stuff just happens, right? It has to pass. One person doesn't make the decision. One person can influence the decision in some ways, right? Depending on which side they have, or they have both, or whatever. But at the end of the day, you can only control what you can control, right? And I think it's important as a homeowner to understand that whoever gets in, nothing's going to happen immediately. It's likely going to take time to go through. If you believe that the economy is weaker and is likely unemployment's likely to head higher over time, just because of decisions that have been made not today, not yesterday, but months ago, sometimes years ago, that are continuing to impact the economy, then that is likely going to have an impact on mortgage rates, housing, and all of these things, right? And so I think you've got to not just think about looking forward, but also look backwards to some extent and think about how those previous decisions are going to impact, not only housing, but just the economy in general.
I would say to piggyback off of that, Jeb, the most important thing where you need to vote and think in terms of politicians have always tried to buy votes, not literally go and hand you money.
That would be nice.
With pet projects of, hey, this is, I mean, I won't even go down that path, but one of the candidates did something here recently that was pretty obvious and egregious and unconstitutional of a plan of what they wanted to do. Our biggest problem in the U.S. right now is massive deficit spending. We've always been a deficit nation going back to the 70s, may have been as recent as the 60s, but it was manageable. It was under control. Post great financial crisis, it exploded. Post COVID, it got worse. And neither of these candidates have any suggestions of how to rein it in. They continue saying, I want to do this. I want to do this. There are different things that they want to do, but both of them are spending. We all need to be insisting that they rein in spending, stop trying to buy votes because it's money that we don't have. And in terms of home ownership and being able to afford a home, that is what will keep interest rates and affordability better over the long haul, because part of the higher rates right now, the higher long-term premiums for mortgage-backed securities, for long-term treasuries, is due to the fact that people are afraid that no one in the U.S. government has even paid lip service to getting these debts under control, and they just keep growing. So until someone does that, we are likely to have higher interest rates than we otherwise should, higher home costs than we otherwise should, despite all of the specific short-term policy questions that each of these candidates are going to have to answer.
Yeah, and I think where I would say is control what you can control, right? You have a vote. Your vote is all you can do. And from there, it's easy to get caught up in the political world. And this person said this person said that. They're going to do this. They're going to do that. In all reality, you have no control over that, right? So focus on what you can control: your credit score, your down payment, where you are in your life, job stability. These things are things that you can control that can have an impact on the bottom line of becoming a homeowner. Outside of that, it's very difficult. So until then, guys, make sure you buy right, you borrow smart, you build wealth. Adios.
Amigos.